Thank you everyone for joining us today. My name is Diana Minot. I'm a credit funds partner at Paul Hastings, and welcome to the first in our series of 3 webinars focusing on social impact investment. And the webinars are sponsored by Paul Hastings, ClearlySo, and Octopus. We've seen a huge interest in funds that have a social impact and that have an ESG factor in them. And in fact, the FT recently reported in the year to February 2020 alone that ESG-focused funds attracted in excess of around $70 billion. So this has been a trend that has been going on for quite a long time. And really the key drivers are around investors and investor appetite. And increasingly, we are hearing that investors want capital to be invested not just for a return, but also invested in a socially responsible way, and in a way that shows investment funds can have a positive place and impact in society. So in recent years, ESG really has gone from just being a request, potentially in side letters from investors, to actually being a prerequisite for investment and almost a bar for performance for managers. And as legal counsel to some of these fundraisers in the market, this is a trend that we're seeing firsthand. And we've seen quite a few sponsors now respond to this increased interest with new products, specifically focused on ESG and social impact. And we've also seen sponsors that already have been investing in a socially impactful way now start to publicly identify themselves as being a social impact investor, which I think is quite a new trend. And of course, what constitutes a fund focused on social impact or ESG can be interpreted widely. And that indeed is one of the topics for our second session on the 4th of June called Greenwashing. And in our third webinar, we'll be discussing debt funds and their recent impact in the social area, which is really quite new and is different from the area previously dominated by equity funds. But turning to today, and given the current situation with COVID-19, it seemed only fitting that our first webinar should focus on healthcare, an industry which historically has seen a lot of activity from social impact investors. And in this period of immense uncertainty in certain industries such as travel and hospitality, the healthcare industry is receiving unprecedented interest. Even before the COVID crisis hit, healthcare private equity buyouts surged to the highest levels ever disclosed. And large investors are now openly stating that healthcare is one of their primary investment targets. For example, BlackRock have recently come up to say that for their ETF products, which are healthcare focused, have had unprecedented levels of investment and interest only last month. Given the requirements for social distancing and the lockdown around the world, we believe that there's going to be an increased demand for technological answers to healthcare solutions and healthcare problems. For example, online doctor appointments and appointments for the vulnerable. And many market commentators think that even after social distancing ceases to be a public requirement, many patients, particularly the elderly, may still choose to use that form of telecommunication. And so it's clear that even past COVID-19, the ways in which we do things will change for the future, and particularly change for the better in the healthcare sector. So with that in mind, I would like to pass over to Rod, CEO of ClearlySo, to introduce the panel for this week's webinar. Thank you.
Thanks, Diala, and welcome to everyone. I think it's fair to say that never before in the history of mankind have so many people had an interest in health. That has to be true. And we're delighted to have today such an exceptional panel to help illuminate that subject, both from a fund perspective and a sectoral perspective, but also from the perspective of individual innovations. And I'm sure our panel will be focusing on those. My role as moderator is very simple. I'm here to prompt and at times provoke a debate amongst these experts and use a combination of questions that come from you and also from me. What we will do is break up those questions into macro questions and then micro questions. So we're going to start at the big level and then go down to the micro level. My name is Rodney Schwartz, and I'm the CEO and founder of ClearlySo. We founded that company in 2008 here in London. And it was actually an idea that came about as a result of my being chair of a business called Just Giving. I came across Just Giving, and I thought it was quite an exciting example of a company that could be massively impactful by generating $6 billion of charitable giving, disruptive by reducing the cost, and also really successful. by exiting at 20 times entry value, which I think any of our panelists here would be quite happy with. So we set up a company in 2008, the purpose of which was to help create 100 Just Givings and raise capital for businesses that are impactful, disruptive, and successful. And ClearlySo is today Europe's largest impact investment bank, raising capital both for such enterprises, but also high quality impact funds, the likes of which you'll see and hear from today. And we raise that money from individual investors, in particular family offices and institutional investors from around Europe. That's my introduction. Now I will turn to Tom and then Ed and then Christoph to give theirs, and then we'll start the questions.
Thanks, Rod. So I'm Tom Castaglia. I'm a partner at MVM. I've been a venture investor for about 16, 17 years now. MVM, I think, was founded in the same year as Rod got started. We were about 20 years old. We're based in London and Boston. We've got about 60% of the team in Boston, 40% in London, although we were originally a UK firm. We invest exclusively in healthcare, but broadly within the space. So we do devices, diagnostics, imaging, drug discovery, healthcare IT, and technology-enabled services to the industry. We manage about $1 billion in total, and we look to make investments in the kind of 10 to 40, $50 million range into each company, with about 50% of the investing in the US, 40% in Europe, and 10% elsewhere. Thanks very much, Tom. Tom and my old company had the same lawyer, and that's how we know we started around the same time. Over to you, Ed.
Thanks, Rod. So quite similar to Tom. So I'm an investment director at Octopus Group. For those of you who don't know Octopus Group very well, we're also about 20 years old. It's our 20th anniversary this year. And we focus on a few key sectors. So one is ventures and new companies. The second is renewables, so renewable energy in particular. And then the third element is real estate. So similar to Tom on the ventures side, Octopus has got about £1 billion sterling under management. On the renewables side and real estate side, we have a sort of about 2 billion or so under management in each of those. We've also got investments into smaller companies. In terms of our healthcare presence, again, that splits down into sort of three things. One is investing into the health venture space. The second is investing in healthcare operating businesses. So we have a small private hospital group, a special education needs school group as well. And then a lot on the healthcare real estate side, and predominantly that is what I do. I look after our care home funds. We've got about 10, 15 years experience investing into this space. So first of all into medical centres, then into care homes, and now really focusing on the retirement living space as well. I think that's probably enough of an intro from me.
Thanks, Ed. And now Christoph.
Yeah, hi, I'm Christoph, and first of all, thanks, Rodney, for having me on a panel. Really appreciate it. I'm personally a medical doctor by training, but I've left the field sort of 15, 20 years ago and have been in venture for a little more than 10 years. At Albion, we're a bit older than the two other organizations. We're 25 years old, but we're sort of roughly similar size to MVM. So we've got about $1 billion under management. We are, like Octopus, actually a diversified fund manager, so a number of different strategies. In healthcare, there's roughly three things we do. One is investments in sort of elderly care homes, and we've been doing that for the better part of 15 years now. And then we have a set of generalist technology investment funds, so those are VCTs, of which Octopus also have a couple. And that is sort of roughly 500 million, and that is all venture focused, and they are sort of software primarily. So in healthcare, what we do there is digital health, and we are probably one of the most active investors in digital health in Europe, having made, depending on how you define digital health, between sort of 10 to 15 investments over the last 6 or 7 years in that sector. And then the last one is actually a fund that we set up with a renowned university in London, the University College of London. So that is called the UCL Technology Fund. That is a fairly small fund, so 50 million pre-seed to seed stage fund. And what that does on the healthcare side, which is about 70 to 80% of the investments, is really at the sort of cutting edge of research. So that is, cell and gene therapy, some of the novel treatments which are starting to hit the clinic and hitting the market, treating cancer and gene defects in patients. So, in total in venture, we've got about 600 or 700 million under management.
That's great. Thank you, Christoph. The first question I have is really going to address the topic of healthcare spending as a percentage of the total. So in developed countries, it's roughly somewhere between 8 and 20% of GDP. Obviously, we have a rather dramatic series of events recently. And I just want to ask the panelists, just to start off, is that share of GDP going to grow, shrink? What do you think over the next decade or so? And let's go in reverse order. So Christoph, let's start with you and then go to Ed and Tom.
That's a very good question. And I think it really depends very much on the country you're looking at. For example, the US over the last 20 years, how the healthcare expenditure as a percentage of GDP has fared. I mean, it's been a dramatic increase from somewhere around 12 to 13% in sort of early 2000s to now 16, 17%. And so, there is a question around affordability, for example, in the US.
And effectiveness, as it's not had great health outcomes either.
There's sort of the irony here, because of course, there are well-known inefficiencies in the system. But I guess the point is, I don't think it's affordable. The US can't actually afford to spend a lot more as a percentage of GDP. If you look, for example, though, at countries like the UK, where we're actually only spending something like sort of 7 to 8% of GDP on healthcare, despite what I guess the government and everybody else is telling you, actually, I think there's a lot more room to grow and to spend. So it really depends, I think, on the specific country. I think it's hard to generalize across the developed world.
Okay. Although that does have, Ed, an impact on sector growth rates. What do you think over the next decade? Will we see that on average rise or fall?
I think we will probably see it come up. And I look at the UK and I think people have realised that both health and social care, and I think it's important to remember that both then, and sort of how blurred that line sometimes is between health and looking after people in the community is. I think in the UK, we're finding out sort of through current events as well that there's perhaps been a lack of focus from government on that over recent years. And I fully expect that to grow. I think also people will start looking at it as a more important part of their spending as well. So whether that is purely discretionary or whether they think that their needs actually change and they actually see some things in healthcare now as more of a necessity than they ever did before. So I think some of it will be public led and we'll see some growth there. I think a lot of it will still be sort of private consumer spending into that healthcare space. And then I think a final point around that is really definitional. And I sort of touched on it at the start. One is that health social care link there and whether it is healthcare or not. The other is around sort of more preventative long-term stuff and even things such as nutrition, which wouldn't traditionally be seen sort of within a healthcare space, will increasingly, I think, be captured in some people's interpretation and definition of that spending.
Thank you very much. And Tom, too, and also maybe if you could give your perspective both from the developed countries, but also maybe you have some insights on the developing countries as well and the implications of that for global health spending.
If you ask me, I think in the developing market, it's going to continue to grow and grow aggressively. I think this market will plateau. And I think in the European market, it will probably plateau and then grow. I mean, I think if you look at what happens in times of economic uncertainty, you normally see GDP falling and therefore healthcare as a portion of GDP rising. What we're actually seeing at the moment now is that healthcare spending is falling quite significantly because people aren't going into hospital, they're not having elective procedures. So if you look at it, particularly in the US, you talk to the big insurers and the claims just aren't coming in because people aren't presenting to the hospital. So I think what you're going to see is you're going to see anything elective, anything that can be delayed, anything that people aren't sure about. I think you're going to see a lot of healthcare spending over the next 12 months that are being pushed back. And we see this across our portfolios, Patients are really reluctant to go into hospital today. So I think what you're going to see is you're going to see a short-term fall, followed by, if there is economic uncertainty, I think you'll see a rise. And then I think in the medium term, I think you'll see a plateau. We've seen a lot of growth being driven by the emerging markets. So all of our companies invest in innovative technology products. And 10 years ago, we didn't think about selling those products in China or Korea or Indonesia. And now those are some of the most profitable markets. I think those trends will continue to grow. They're still significantly underinvested in healthcare in those markets.
Well, we'll definitely come back to that during our discussion today. Let's shift from the big picture specifically to the funds picture. So obviously demand is going to be driven by health spending, but in terms of the companies that you're investing in, a lot is going to be affected by the flow of money. What's been happening recently in terms of the flow of money into health funds? And have we yet been able to discern any distinct impact yet on valuations? So let's start this time with Ed.
Yeah, thanks. So I think what recent events have done is bring up in people's consciousness that A, there are these sort of healthcare investment opportunities, and B, in a lot of parts of healthcare, that it displays defensive qualities because in a lot of cases it is driven by really strong demographic fundamentals, which broadly in the developed world are aging populations with comorbidities, lots of underlying health issues. And that sort of wave of increasing health needs in that part of society isn't something that's going away, and certainly hasn't peaked as well. So there are lots of things and short-term noise going on, as Tom pointed out, sort of elective surgeries, people getting into health facilities in some cases is down. Sort of the longer term trend, and that we've seen and that has driven a lot of investment into the sector, is really that demographic side as well. In the last few weeks, sort of speaking to various people in the sector, I think there is, again, even more interest from people wanting to get invested into the health sector. I think, as Rod, you sort of mentioned in your opening remarks as well. And we see that. I think some of it will be understandably cautious and want to see just how things pan out, but they're sort of starting to do their early stage due diligence at the moment, realizing that there are these opportunities out there as well. So I think in some markets, we expect to see some new investors and some new participants.
Thank you. Tom, can you quantify at all the sort of flow of funds into the health sector?
It's been a great 4 or 5 years, I think, for anyone that's managing healthcare money. I mean, if you look at most of the funds in Europe, they're probably 2 to 3 times the size that they were 10 years ago. There's been a lot of new entrants into the market. There's been a lot of new financing models. So actually, I think we're at the end of a lovely warm summer. And, the question is whether or not that is going to continue into an Indian summer, or whether the market is going to readjust in a more aggressive fashion. And I think it's too early to say, and I think ultimately it's going to be driven by NASDAQ, because, NASDAQ drives exits, exit drives returns, returns drive interest into people investing in these funds.
And before we turn to Christoph on that question, have you seen this had much of an effect on valuation? So are the very high levels of the NASDAQ, or at least until recently, have they really affected the valuations that you're being forced to pay?
Yeah, the valuations are up a lot. If you go from kind of peak to trough, I would say, so from kind of 2008 to, let's call the top of the market, the 1st of January this year, my guess is for the same asset, the valuations were up 60 to 70%.
And Christoph, over to you. Both 2 questions, really. Flow of funds into the sector, and secondly, what impact it's having on valuations. Actually, if you could also comment on current valuations. So have we seen much of a drop as a result of the recent pandemic?
Clearly, there has been an impact on valuations in the very sort of first couple of weeks after the sort of crisis struck and the magnitude of the problem became apparent. And that was just a broad-based correction in all valuations. What you've seen since actually, if you look at most of the big pharma stocks, they're actually at the same level as pre-crisis. Some are even up. If you look at sort of more health tech, some of the sort of leading stocks there have benefited enormously and actually up 30 to 40% from pre-crisis levels. I think based on, in line with what actually Ed and Tom was saying, actually the sentiment certainly isn't a negative one for the sector. I'd sort of add that in terms of the valuations overall, over the sort of a longer period of time, clearly valuations are compared to say 10 years ago. I mean, there has been a bit of a correction, specifically the biotech market over the last 2 years. But, nothing sort of dramatic. And I think at the end of the day, whilst, I think the short term is always driven by market sentiment, I think in the biotech and sort of the area we invest in, cell and gene therapy, a lot of it comes down to how good is actually the science behind it. And if you've got really great science and great IP and great patient outcomes, you will create value.
Great. Actually, you mentioned biotech, Christoph, and I think we should start to go into the area of regulation. But before we do that, let's talk about just the broad kind of governmental perspective. So we talked about healthcare spending in the different countries. Different countries have different health systems. In the UK, a single payer system. In the US, largely privately funded. In the European markets, more of a mixed bag with a lot of insurance. Do you think we're going to see any dramatic changes in terms of the structure of health systems in these developed markets, which is, I guess, still the bulk of healthcare spending? Let me start with you, Christoph, if that's all right.
I'd love to see changes. We were talking about the US before. I mean, I think, there's a lot of inefficiencies there. And I think a lot of people would love to see changes for the better. Equally, I think that personally, I feel there are changes in the UK that are, long overdue and in other countries as well. I think the reality is that sort of the systems we've put in place are extremely difficult to change. Okay, so if you are thinking that actually you're sort of a free market capitalist and you would love the UK to be completely privately funded, that just ain't going to happen. I can't personally see that happening. Equally, if you are sort of more of a socialist ilk and in the US and you would love to see much more of a sort of a state-funded system, I equally don't think that's going to happen very quickly. There certainly are pressures everywhere in the system, and those pressures just mean that I think in countries which are more sort of state-funded, you will see, I think, action to contain costs more readily than in a system where, in the US, where the incentives are such that actually people are going to try to continue to charge for services and extract as much money as possible. Those things will continue to have an impact, but will we see broad-based changes in the way the healthcare is sort of funded and delivered? I don't think so. I think they're going to be incremental and slow over time.
But I guess we're going to see a drift in some direction, or we might see a drift, or maybe you think we're going to see a drift in one direction or the other. Tom, do you think the US is going to look more like the rest of the world? Do you think the UK is going to look more like the rest of the world? Which direction do you think we generally will travel in?
Well, I think it's very obvious what direction we should all go in, which we should look a little bit like Germany and Sweden, a hybrid of those two systems.
We all want to be like Germany and Sweden in everything.
We have well-centralized payors. We have a high supply of medical professionals. We have a high level of competition in terms of providers, and we have good quality measures ensuring things are good. Everyone's known that for probably 10 to 15 years. That is the model to deliver the most cost-effective and the highest quality healthcare. Anybody that's spent 10 minutes thinking about it knows that's the case. But it's never changed. The US still has their crazy system. We've still got our crazy system. Why is that? It's vested interests and it's politics. And I don't see those changing. I don't see the participants of the NHS saying, we want to go into a much more competitive environment now. And I don't see the people in the US saying, do you know what? I want a single payer who's going to screw me down and pay me $5,000 for a hit rather than $30,000. It's just not going to happen. So something's got to initiate a drive to get over those. And it's either going to be a really brave politician or it's going to be the system goes bust. I don't see either of those happening.
Well, I guess we had a brave politician in the US, but just didn't make as much progress, I guess, as we thought. Last question on regulation, and we'll start with you, Ed. There's going to be, at some point in time, a vaccine. We hope sooner, maybe later, maybe never, but we hope sooner. And initial indications are that people are going to provide these vaccines at cost, or at least that's what's being suggested. And I just wonder if you think that is going to be the case. And I wonder if you think that we're going to see this sort of thing set a pattern for other diseases which are of serious international concern. What are your thoughts?
I actually think that there are a lot of links back to the last question there, and it really depends on how your system is funded. So in somewhere like the UK, I can certainly see, in terms of the vaccine coming out of pharma, there's a question around sort of whether that will come in at cost. What will be the cost to people getting that vaccine? I think we'll see sort of nationalised vaccination programmes in the UK. Sadly, I think it will depend really on sort of political discussions here. And for the UK as well, sort of deciding to have moved out of Europe, I think will be a big element of that. So how well can it still rely on some group purchasing power or collective commitment on cost to buying that if there is, say, a vaccination coming out of European-based pharma? But I think that the systems in particular and the way that they interact with pharma and what they expect, including their own domestic pharma, is going to be pretty key to that answer.
Christoph, and then Tom?
Yeah, so I agree with that. I mean, more specifically, I guess, on sort of regulation and governance generally, I just want to give you an example of one of our portfolio companies, which is a digital health business that sells into the NHS. Okay, so it's basically mobile communication. And the sales cycles pre the crisis was about 6 to 12 months, which is quite normal for a UK hospital trust. That has been reduced to somewhere between 24 to 48 hours in the current environment, because the service they're providing is mission critical in a COVID pandemic. So you can see the impact actually the crisis has on governments generally and regulation, similar around sort of vaccines and approvals. And I think that's great, and that's absolutely welcome. I don't think that is sustainable. I think people will, once the crisis is over, whenever that is, the virus is under control, I think we will switch back to normal. I mean, regulators will switch back to normal. Data privacy will be as important as it has been, if not more. What I think will remain is the sort of behavior change, because that's what you're seeing when people, you mentioned it earlier, teleconsultations, and we may come onto that. That initial adoption hurdle, once you've taken that, and a lot of people have, then actually realize, well, that actually works and want to continue doing it. So I think that's the thing that will remain with us after the crisis. All the sort of good stuff that came out of it will hopefully remain with us. But in terms of regulation, I think, and data governance, I think we will go back to where we were before.
Tom, would you like to take that question as well?
Yeah, I mean, I think in terms of giving the product away at cost, I would be against that, my view, which is, what you're seeing COVID do, which is government's got out of the way and about 100 vaccines have started and about 1,000 clinical trials have got going because government's got out of the way. And it's just a classic example of get rid of regulation, free up the market, and wonderful things will happen. But the reason those wonderful things are happening is because people think if they crack this, which is probably the biggest economic and maybe healthcare disaster that's happened in my lifetime anyway, if you win, the prize is going to be enormous. Now, if the prize isn't there and at the end of it, the product just has to be sold at cost, next time the private sector is required to do this, what are they going to do? Well, the boards are going to sit around and say, and what happened last time? We developed that great product and nobody made any money out of it. If the state wants to fund it and give it away for free, great, but it's going to take ages. You're not going to get as good a product. If you want the private sector to engage in it and they're successful, let them make money. The guys that are selling masks, the guys that are selling oxygen, every other person that's contributing to helping in this crisis is getting paid. Why should the person who comes up with a vaccine and lets the world economy get going again be the person that's not rewarded? It's nuts. Sorry.
No, I just as a follow-up to your impassioned plea, I get the point, but as an investor, you have to take a view on what's likely to happen. Do you think that there will be pressure for people to give stuff away, or do you think that that will pass in time?
Unfortunately, I think the governments are going to sweep in and make up the rules. It depends entirely on where the product is developed. I think if it's developed in the US, you'll probably get paid for it, but it's probably going to spend most of its time initially treating US patients. I expect there to be a lot of protectionism in how the limited early supplies of vaccines are handed around. Sadly, I think that is the wrong thing to do, but I think that's what will happen. I think it depends on which country it is. Some countries will just take it and not pay for it, and others will.
Great. I did say that I would take questions from the field, and we've got a few before we go into some of the more micro areas. So one question from Krishan Patel. Given the stimulus in the wider economy, is there a view at a national level, I guess that means the UK, that public finance will be increasingly looking at private finance in the health sector? And if you want to take that on from a UK perspective, Ed, go ahead.
I'll volunteer. I think it's important to look at sort of what is happening at the moment and which actors are delivering care at the moment. So predominantly in the UK, it is the NHS that is really stepping up, and all of that funding and extra cost is going to be borne through the NHS. It is hopefully relatively short to medium term, the effects of COVID. And while things like sort of independent hospitals have all got together and made their hospitals available for use by the NHS, and similar things have happened sort of on the care home side, I'm not sure sort of just immediately that there is a huge amount that is going to be done into the private side. There are some exceptions. So things like in the care home world where full nursing care, that the rate that the government pays that, so that is where a resident's very ill and actually needs nursing care, that has been increased. VAT on PPE is going to be taken away. And so private operators will be able to reclaim that. So there is some funding into the private sector there as well. Is there going to be a lot of government money coming into the private side to sort of make COVID be cured better and get through this a little bit better? Maybe a little bit, but I don't see that as being a sort of long-term drive. I think longer term, though, the discussion in the UK about public versus private provision often is around the provision of expensive kit, around health infrastructure as well, and whether from a capital perspective that is better funded by the private side, and then the NHS sort of pays some ongoing costs, some rental costs. It looks like some kind of rental arrangement going forward. And there has been a debate in the UK for 5, 10, 15 years about the extent to which the private sector should be providing some of this health infrastructure and is better placed to do it, and has already raised capital and shown that it can do it.
Okay, let's move on. Sally Dewhurst asked a question, which is about the nuances in healthcare investing compared to other sectors. Christoph talked about the value being driven by fundamentals of good science. Are there any other factors that are really specific to the sector? Why don't you take that, Christoph?
Yeah, sure. I mean, I think one of the perspectives that sort of we have as an investor that invests in, for example, sort of generalist technologies, so software, high growth software businesses and life sciences and biotech, is that you can see what the differences are. And there are quite a number of pretty fundamental differences if you invest in early stage biotech or drug development businesses, in that you fund these companies not to commercially grow a product. You basically fund these businesses to understand whether the science actually works in the human. So you've got, when you've got a sort of a very simplistic level, a molecule that you think is going to work and make a person better or cure a disease, you've got to test that in that person, because the human organism or biology generally is so complex that you always have to run these clinical trials. And that is a very specific sort of risk profile where you need a lot of expertise and understanding. And I guess some people on the panel here think at least that they have. Whereas I think if you look at a software company that has certain customers and wants to grow commercially, that is a very different risk profile that requires a very different sort of skill set. That requires, different sort of things to look at. So, I mean, that at a most basic level is what sort of the big differences are. One case, you're actually backing sort of biology, science, and the other case, you're actually backing, I guess, commercial scaling. So, I don't know if that sort of answers the question. But.
Okay, thank you. I don't know if anybody else wants to take that, or I have a final question then on this macro section. So we'll start to get into the cool stuff of innovations and all that after this last question. But Tom, I'm going to start with you. And I'm starting with you in particular because I know your organization invests globally, and in particular quite a lot in the US. So there's historically the view that US firms are better at commercializing the sorts of innovations that take place. Tell me if you think that's true, and tell me if you think over the next 10 years that will still be true, or if we're going to see the gap in terms of commercializing IP close.
So I think if you look at the commercial successes in healthcare innovation the last 10 or 15 years, I think undeniably US companies have done a better job of it. But I think actually the real answer is that the person who is operating in the biggest market is the person that's the most successful. It's, you can have a really, really great executive, the best guy in the world, but if he's selling it in Portugal, he's not going to do as well as a mediocre guy that's doing that in Pennsylvania. And I think that's all you see, really, which is for the only really decent, profitable market to sell healthcare products in the last 10 years has been the US. I mean, trying to make money in Europe is pretty much impossible. Actually, increasingly in Asia now, it's an interesting place to sell products. So I would say in the US market, you're always going to back someone who knows the market, they've got deep relationships, they speak the language, they understand the social nuance, they understand the system, they're politically connected. Of course, they're going to do a better job than a European. I guess the question, which is, if you look at how successful European or US companies have maybe been commercializing in China, I think actually you can't necessarily draw the same conclusion, actually. I think European executives and US executives have probably done about as well as each other. So I think it's just you're playing at your home ground, right? You always do better.
I'll turn to Christoph in a second, but let me just press you on one thing. You referred to the Portuguese entrepreneur as focusing on Portugal, although you could argue that he or she is actually active in the European market, which is comparable in size to the United States. Are you suggesting that there isn't really a European market at all, or can you develop that?
I love that. I love that. It's a man that thinks the healthcare market works by geography. European healthcare doesn't exist. It's a disaster. It's highly fragmented. It's lots of language. It's a terrible place to sell healthcare products. I very rarely see someone with a highly innovative healthcare product make money in Europe. Every company that comes in telling us they're going to do it, we say, look, get some clinical experience, work with some KOLs, but don't invest in it. Don't make money out of it. License, partner, use distributors, and spend your money building commercial infrastructure in the US.
Right. Christoph, do you want to, I guess as the true European on our panel, do you want to argue against that?
Yeah, no, I mean, I have lots of thoughts. It is absolutely true. The US is the biggest market. And so therefore, from a venture perspective, $1 invested or €1, £1 invested, it's going to give you a lot more return if you tell your portfolio company to focus on the US. And we've seen this with our portfolio companies. I mean, we were invested in a whole host of sort of digital health companies, of which there are comparable companies in the US. And guess what? The US companies have IPO'd on NASDAQ and they're valued at 2 to 3 billion, whereas ours are valued in the tens of millions, because they're going to have to go from the UK to Germany, to Switzerland, to France, and each market is a new market that you have to understand all the nuances in, and you're going to have to do all the learnings almost all over again. So it is just very, very inefficient and very capital intense. I mean, the flip side of that is, of course, if you have managed to actually grow a European business, if you put the blood, sweat, and tears and the money into it, you actually have something which is quite valuable and for which Americans are willing to pay for it. Fundamentally, I agree. The American market is the biggest market in healthcare. I mean, I don't know who said it to me. This was almost a decade ago now. It was a pharma executive who basically said all the European pharmaceutical research is effectively funded by the Americans because the profits are made over there. I mean, a last thought maybe, and this is sort of more going back to the previous point that was made. I mean, people, complain a lot about the UK healthcare system and look to Germany. And I'm from Germany. I practiced in Germany as a medic, and I also sort of did commercial stuff on the healthcare side in Germany. And actually, it's not all perfect over there either. And you have to remember that the German system is also 100% financed by the public purse. It is just differently structured. And there's less of an angst, I guess, around privatization. And about 40% of healthcare deliveries or hospitals are actually private. And all of primary care is completely private in Germany. So I think they have sort of a slightly better system over there, but it's also publicly financed. And our experience from the digital health companies we invest in that are active in Germany and the UK is that the UK is actually pretty far ahead of the curve compared to other European markets when it comes to digitization and technological innovation in the healthcare market.
Disappointing to hear Germany's not perfect, but I'll get over it. Let's start to talk about some of the more innovative stuff. So let's start by with a big question as we go into the micro. Where are you guys investing? So what are you focused on right now? Let's start with you, Tom. What do you think are the exciting areas?
If you look at our portfolio, the thing that we've been focused on for some time is anything that materially reduces the intensiveness and therefore the cost of healthcare. So it's all about taking procedures that are done in the operating room and to get them being able to done on an outpatient basis, or things that we've done on an outpatient basis being done in the doctor's office. And I think, that really is because that's what patients want. It's cheaper. It's what the healthcare system wants. Often there's resistance from incumbents within the market. And for us, that's really been a theme that, I think has been something we've been doing probably for the last 7 or 8 years.
Do you want to give us an example?
So we've invested in a company called Providence Medical, and this is a product to treat degenerative spine of the neck. So when the vertebrae in your neck start to degrade, they start to move back and forward, and it causes pressure on the spinal column and pain. So the traditional way that you do that is you do what's called a spinal fusion, where you basically slice open the neck, move all the meat apart, and drill a couple of holes and put some rods in to...
Thanks for the visual, Tom. Yeah,
to stick the neck together. And then if you're really unlucky, that doesn't work, and you've got to do it from the back as well. So that is obviously a highly invasive procedure, lots of comorbidity, takes a long time to get better, you get infections, horrible thing. So we've invested in this company called Providence, and they can do in a 45-minute procedure through a little keyhole trocar, 2 little cuts at the back of the neck, and they slip a couple of wedges between the facets, which is as part of the vertebrae, the neck bones, and they put a bit of cement in there, and it basically stabilizes them until they fuse naturally. It's a product. It's a 45 to 50-minute procedure. It can be done same day, patient's out of hospital. For a patient to come in and say, we're going to do a little keyhole procedure on your neck, you're out the same day, it's a much lower hurdle. These tend to be pretty sick patients anyway. And in terms of the total cost of delivery of that, probably reduces the cost by 70%.
Wow.
So that's a theme that we've been investing in for a while. What's nice is at the moment, nobody wants to go in hospital. So anything that makes hospitals or any procedure less invasive, less time in hospital, do it at home, be an outpatient, go in for a day. It's a trend, I think, that has always been rational, but I think this crisis is really pushing it forward.
Thanks. Ed, I know Octopus has different bits of it, but can you give us a sense of where you're investing and maybe one example?
Yeah, so I'll sort of leave the real sort of deep tech or deep medical stuff to the other 2 experts on this panel to explain. So I'd say sort of some interesting areas on the venture side we looked at are around the consumerization of health. And these are things that might not need sort of heavy medical intervention, but things that do affect people in their everyday lives. So things around addiction and mental health. So our team on the ventures side sort of invested into portfolio companies now that are really looking at that and where it is consumers being able to control that. So they get self-service in so much of the rest of their life now. They want to be getting that in a lot of their health treatment. They want to be in control of it. They want to be able to have those products, whether they're very heavily tech or not, if they're monitoring them as well, but that they're in control of, they're seeing the output of, and it's interpreted in a way that they can understand without needing to go through a medical professional and go and sit and have a consultation in their room. So there's clearly sort of a big area around that, including an area that can broadly be called taboo and sort of places that people are sometimes a bit nervous, concerned about mentioning. So things around sexual health, certainly around mental health as well, which thankfully is becoming much more spoken about generally in the workplace and catered for. But clearly there's a lot of investment still to do there. And then on the sort of real asset side, what do we see? So clearly there's a huge amount of technical innovation, but there is a lot of healthcare that still needs to be delivered in person and care there. And their tech sort of might change or adapt or enable it to be delivered in a slightly better way. And as Tom said, really focusing on efficiency of delivery there. So we see it even in care homes and hospitals. A long time ago now, the move to electronic patient records. But actually a lot of providers in a lot of countries took a long time to catch up. And there are still around the world, even in a lot of developed countries, a lot of medical notes that are written in pen and ink. And I think moving that and then using that data that comes from that to be able to do better care plans for elderly patients as well, predictive technologies around predicting falls of older people, trying to stop big medical events happening. And then if the public sector is paying, making sure that every pound is spent in a better way earlier on, so that you're not treating very, very serious illnesses or acute instances of stuff down the line. If you can stop those falls happening in the home, for instance, that's a huge effect for a 70 or 80-year-old.
Thanks, Ed. Christoph, where are you guys focusing? And maybe you want to give us one example.
Sure. So, I mean, as I said in the introduction, there's three broad strategies we have. One is care homes. The other one is digital health or health technology. And then, sort of early stage biotech and mostly cell and gene therapy. So I guess on the cell and gene therapy, this is very much driven by what comes out of UCL. And UCL's strength is probably the leading academic institution in the whole of Europe when it comes to cell and gene therapy. And the number of trials they run is, as much as the whole of France or whole of Germany, for example, in any given year in that field. So we're seeing a lot of really interesting companies in that sector coming out of UCL, and we're funding those. An example of that would be, it's a company called Octopus Therapeutics. They floated on NASDAQ in 2018. They have a novel, platform to deliver gene therapy for monogenic diseases. So these are diseases which are caused by a single gene defect, typically manifest in very early childhood, shortly after birth. And their lead indication is a severe combined immunodeficiency, which is colloquially known, and some people may know that as bubble boy syndrome. So these kids, because they have no functioning immune system, they're born, they develop severe infections, and then they have to basically live in a hermetically sealed tent for their very short life. It's extremely expensive, a lot of suffering for the child, of course, for the parents, and ultimately fatal in the first sort of decade of life. The therapy that Orchard developed cures those kids. It's been now in about 300 children. And as I said before, they would have died at the age of 3 to 4. And some of them, are now sort of 7, 8 years old, completely symptom-free. They are cured. Now, when I trained as a medical doctor 20 years ago, that was just, it was unheard of. Cure is nothing sort of medicine was really able to deliver. It's mostly symptomatic treatment. But I think we now live in an age with cell and gene therapy where actually, some of these monogenic diseases certainly you can cure, and that's quite exciting. And that's what we do out of UCL Tech Fund. And then, the health technology investing, that is very much centered around mostly, software for one, the pharmaceutical industry, life science industry, but also to selling into providers. And I guess on the providers, so, hospitals and GPs, one example, a company called Oviva. That is one that is active across several European markets. And they have in one phrase, they're sort of a digital type 2 diabetes therapy company. So they have a platform that helps patients take better care of their diabetes with the help of a dietitian, but using all sorts of digital tools that makes the whole sort of patient journey just much more user-friendly, makes the therapy more effective and more efficient.
Right. Thank you. Christoph, you mentioned the word platforms, and one of the platforms, let's say, that's been getting quite a lot of attention lately is robotics. Another is artificial intelligence platform. It's a funny kind of word for artificial intelligence, but none of you have mentioned those areas. Is there appetite in your funds for things in the robotic sector or things that are making use of artificial intelligence, smart learning, etc.? We'll start with you, Christoph.
I mean, I think specifically on the topic of artificial intelligence, which is obviously a big topic, has been for the last couple of years. Our view is that it is just a tool. Artificial intelligence is a tool. It's an efficiency tool or prediction machine almost. Okay, because these algorithms help you predict better. And so that in itself is not something I think that we would see as an investment thesis. For us, an investment thesis has to be built around a certain market, a certain business model, and a certain team. So yes, absolutely, we're seeing AI being applied in more and more of the companies that we are investing in. And, it is important because you want to make sure that you have the latest technology. And so, I think in certainly the digital health side of things, the companies that we're investing in, even the ones that we invested a long time ago, they are now starting to integrate AI into their tools to make it more efficient, to leverage the benefits that AI brings. But it is just a tool. It's open source, most of it anyways. So there's very little differentiation and protection around it. That's basically the way we see AI.
Maybe, Tom, maybe you have more to say on AI, but I'd like, if possible, if you could pick up also a comment on robotics, and then I'll turn to Ed.
I think I've probably got less to say. I totally agree. I think it's just a tool. I think when teams come into us and say, this is all AI, it's wonderful, it's black box, isn't it great? I normally think you've got no product and no customer that's willing to pay for it, and that's why we're talking about AI.
Robotics?
Robotics, I think, is super interesting. We've looked at a lot of robotics technologies. I think that it used to be quite easy to be in robotics because they used to be just a calling card for hospitals. Hospitals would buy Da Vinci even when the procedures took 4 hours longer and didn't give a better clinical result because they wanted to have a big banner on the highway saying, come to our hospital, you can have robotic surgery as done by NASA. I think that world's changed. And I think if you're going to do robotics now, you've really got to believe, A, it's more efficient. B, it doesn't disenfranchise the doctor too much because otherwise they're going to get in the way of it being adopted. And that it's sensibly priced, i.e. it lowers cost or is not. And that you can quickly generate data showing it's better. So I think the hurdle is higher than it used to be, but some of the technologies are fantastic. So we saw a really interesting robotic technology where people basically had managed to do a closed loop between a robot and an MRI machine. So basically you could do interoperative positioning, which is great, obviously, for soft tissue. When you start doing the procedure, everything's moving around, so you can't get pinpoint accuracy anymore. So I do think there's some really, really interesting spaces. There's a lot of hype. There's a lot of very highly valued businesses that really don't either save cost or massively improve the clinical paradigm. For them, I think it's going to be a tough time.
Right. Ed, I don't know if you want to comment on that. We're going to go in a second into another buzzword, that of telehealth, which has already been mentioned here a few times. But do you want to comment on AI, robotics, and any other hype platforms?
No, I think we'd agree with that. I think with all of this stuff, it's about application. And whatever health environment you're in, as Tom said, it's either got to have a demonstrably better clinical outcome or it's got to be more cost effective. And there are certainly things that can be used to do that, but it is that application and realizing that not everything can be replaced. It can help people do things a little bit better, but there is a limit in most kind of applications.
Thank you. So I'm going to ask questions about care shortly. I know that's a big issue right now, especially in the UK, for some obvious reasons. Before we come on to care, I'd like to ask for a little bit more of a developed conversation into what we're calling telehealth. Let's start with you, Tom. Telehealth, another word we hear a lot. Can you unpack it a bit and also maybe give a colorful example of something that you found interesting along the way and maybe have invested in?
We don't have a lot of experience of it, to be honest with you. We've looked at a lot of companies in the space. We've done one, which was basically enabled remote diagnosis of peripheral artery disease. So basically, when people went to the foot doctor in the US, we had a device that sat on the foot that took a measurement of arterial flow, and then it sent it through to a vascular surgeon to do the diagnosis. So that was a nice business that, the vascular surgeon liked it because it got them patients they could do procedures on, and the podiatrist or foot doctors liked it, and we had a kind of telehealth solution that linked those two together. And I think that grew very nicely, delivered good care to patients. But that's an outlier. I wouldn't say we are in any way expert. We see a lot of businesses out there. Many of them we don't find that compelling.
Thanks. So it was you, Christoph, who mentioned the word telehealth, and I think had some interest there. So let's turn to you.
Yeah, so we have two investments. I mentioned one, Oviva. The other one is a mental health, you call it tele-health, business. It's sort of a tech-enabled services business, which which uses telehealth. So it uses sort of video conferencing, but it also uses other remote sort of tools and chats and, functionalities to improve the user experience, efficiency, and effectiveness of care. And I think when people talk about telehealth generally, what most mean is a teleconsultation, so the remote GP consultation model. And that is obviously at the moment with COVID absolutely flying, through the roof, not just here in the UK, but everywhere. I mean, all the teleconsultation businesses that we're aware of, and we're reasonably close to a number of them, they're growing extremely strongly, for obvious reasons at the moment. It goes back to what I said earlier in that I think there is a, sort of behavior change which is happening at the moment, which is driven by the crisis. And I think some of that will persist. So you will see more people just doing remote consultations. It won't just be the concerned mother with a child, Sunday at 9 p.m. when you can't get an appointment. It will just be also your routine stuff. And the sort of the chronic care patient actually says, well, I don't really need to be in front of the physician. It's fine if I'm face to face. I may have my own blood pressure monitor and give him the reading there, and that all works fine. So I think you will see a permanent sort of effect on that. It's not that it changes something dramatically. It brings forward, I think, something that would have happened anyway. So we're sort of jumping 5 years ahead is, I think, what's happening with the whole sort of teleconsultation market.
I know from my ClearlySo colleague and I, Carl Burkholtz, that there has been a lot of interest in this area. In fact, I think our first intermediated investment was, I guess, technically a telehealth company, a company called Psychology Online. I guess it's pretty easy to figure out what they do, although they changed the name.
Called ISO Health, yes, we know them well.
ISO, exactly. Now nobody can figure out what it does, but it's apparently very successful. Ed, do you want to take this issue before we move on?
Yeah, in terms of sort of some real world examples of that. So I used to sort of invest into GP surgeries, medical centers, and I think it's good seeing that the video conferencing really now pushed through the market very quickly. So even going back 12 months, there's some really well publicized companies doing it and moving through and actually taking over primary care and doing it in that way. So people like Babylon. But I would just say there were still lots of GP practices around the UK, for instance, so primary care practices who did that and were having telephone consultations or video consultations. And I know quite a few who we spoke to who we used to love investing in because they were moving forward with call centers. And some of the buildings we provided to them, they sort of kitted out as call centers to take in a lot of phone consultations and effectively really screen those patients ringing in, those that can be dealt with very easily over the phone. And going back to the sort of underlying theme about using tech to deliver healthcare at lower cost more efficiently, because you're stopping people coming in, stopping people who don't need to see a doctor coming in and having a GP appointment. So I think it's done. I think this will accelerate it. Everyone's seen that. So a lot more people doing it now, a lot of GP practices across the country having to do it. What's interesting is to see how some of these video conferencing or telehealth companies now push on to the next level. And I think for them, it is pulling huge amounts of rich data and seeing then what they can do with that. And I think it's moved already from when you see those companies emerge, where it was just really a bit like Zoom almost. That sort of was the offering. You can just have a lot more of your consultations over the screen. So now really pushing on and having those bots asking you the questions before. We see it in the UK, a lot of people with the 111 service as well. The big thing though is making sure that it doesn't always lead to a pathway that says call 999 and call an ambulance. And I think there's still a lot of refinement to do around that. And it is how trusting consumers of healthcare will be to these systems where they're using it and in their mind still making big decisions on it, particularly where you've got vulnerable patients. So I think there's a lot of press around this works really well for sort of the middle ages, so young adults and everybody else who are quite in control of things. What is it like for comorbidities where you've got symptoms sort of crossing over? What's it like when you've got an infant who, as a parent, you don't quite know what's wrong with them? Will you trust a bot to spit something out rather than taking them down the road to your GP as your primary port of call? So I think there's a lot of development to do there as well. And I think also you've seen some of those companies in developing countries leapfrog. So a lot of vested interest in developed countries in the healthcare systems and how you go and get your care. A lot of these companies have seen their real progress in what they're doing in developed countries where there just isn't the health infrastructure and the network. They can try things because there are loads of people who just don't have access to healthcare. So anything is better than nothing. Whereas in the UK, for instance, it's always pitched against, is this better right now? So you sort of see that risk. Is any one patient going to trial that they're going to put their hands in the life of a bot rather than a physical doctor? So I think there's still a lot to come out of there, and a lot of lessons to be learned from application in the developing world of those technologies.
Okay. I promised we'd come to care and physical facilities, but we're not quite there yet, because there's one question I'd like to ask first. This is a panel not just on health and not just on innovation, but it's also about funds. And a lot of what funds do is what fund managers do to enhance the value of companies. So moving aside from the technology and the buzzwords and the platforms, you as custodians, portfolio managers of companies, your ability to deliver high returns to investors is going to be importantly a function of your value add. Tom, this time I am going to start with you, and I know you have a view on this sort of thing, so pressure's on. What are the sorts of things that, not you as a fund manager, but you as MVM do as fund managers, which add value? And then I'll go to Ed and Christoph.
Yeah, so I think it's important to sort of talk about the stage of the companies that we invest in. So we're typically investing in businesses that have already gone through the regulatory phase, they've already launched products, they're often maybe turning over $2, $5, $10 million at the point that we invest. But they come often very much from a kind of, an academic research pedigree. And I think what we really try and do is just look to bring the experience that we've got. I think we, across our team, have probably launched about 30 healthcare products, most of those into the US market. So in terms of investors with a sort of European base, but that have really got experience of how do you take a product or a technology and make it the right form factor, get the reimbursement right, get through the hospitals, build management teams, build sales and marketing infrastructure in the US, and then look to target accounts. I think that's really what we bring to our companies. We have, I think, 6 guys out of kind of Bain and McKinsey who used to do sales and marketing optimization studies for big pharma companies. So we can turn up to a small company and say, look, we're going to put a little team on it. You'll get the equivalent of a Bain or a McKinsey project. We'll do it in a month. It's not going to cost you $1 million. It's going to cost you nothing. And out of that, we'll do a really nice market segmentation. Which are the customers? What's the message? And really give them a kind of guide that then their existing management team can go and take and look to scale in the business. So I think it's really sort of experience, it's network in terms of people that we know that we can help in the companies. And then it's a sort of a degree of strategic oversight that the companies can't afford. And they can't afford to get that kind of work done. And we've got that capability in the team to do it.
Thank you. Ed and then Christoph, same question.
Yeah, so I think in terms of the value add, one question and that bridge between the investment coming in and where it goes. In the healthcare side, a lot of people are concerned around reputational risk, and people who haven't come into healthcare before and invested into that, whether that's into real healthcare assets or more technology-driven solutions. And I think a key thing that a fund manager or an experienced investor can do is understand that regulatory environment and the risks that are involved in healthcare investments, and invest properly in covering those risks off to try and stop issues developing down the line. And I think it goes to, everyone would love those investment opportunities and those products where you literally can just go in and get the right thing and then crank the handle really, really quickly. And in consumer world, you can do that. I think in healthcare, you've always got to make sure that when you do that, the care is still, or whatever it is being delivered, is being done in the right way. And there is that ethical overlay and moral overlay that is really, really important. And investing into that and understanding that and trying to at least see where there are the accidents down the line, where there could be, is a really, really important part of that.
Thank you. And over to you, Christoph.
Yes, I want to talk about the two, platforms that I'm involved in, which is one, the UCL Technology Fund and the digital health investing. So on the UCL Technology Fund, we are there at the very outset. Okay, so it's really sort of company creation. So what we do is we go around the university, we identify the really exciting science, and that in itself is sort of a big project every time, because we really need to look at the markets, what are the trends, and then trying to sort of put together sometimes actually not just one piece of IP from UCL, but actually from outside to really sort of get the best IP in the world into that company. And then the other thing we do is we try to identify that management team. Oftentimes, the academic founders aren't entrepreneurs in the classical sense. So they're not, they haven't run businesses before. They don't have the skill set. They're brilliant scientists, but they're not good at growing companies. So we identify the early management, the board, sometimes the chairman, and really sort of then put everything together. So it's proper company building that we're doing at UCL Tech Fund, which is very, very hard work, but it's great fun, especially when it succeeds. And on the digital health side, I mean, those are later stage companies, so tend to be sort of Series A, late C to Series A. So that means they have product on the market, they've got an existing management team, and somewhere between sort of 10 to 15, 20 employees. And we want to help them get to sort of a couple of hundred employees and then exit. And so that's a lot around actually some of the things that Tom and Ed said, which is around actually strategic thinking, where do you really want to go, the market segmentation, and so really sort of advice, but also crucially advice around how to build out the team. That's quite important in these sort of early phases, because you have a very talented CEO, but if it's first-time CEO, they don't have the network, they don't know who the good CTOs are, they don't know, where the good sort of chief commercial officers or VP sales are, especially if the angle is, well, we want to expand in the US. And so we get very, very active in trying to help them recruit, the teams to enable the companies to scale.
Thank you. And now we will turn to care, and we're definitely going to start with you, Ed. Bit of a disaster here in the UK right now, and not everybody is from the UK online, so maybe you can share some of that. But also, what is the future of physical care facilities going forward? How is that going to change? Are people, with telehealth, is there going to be an increased demand for physical care facilities, or is it going to plummet? And which areas might? I mean, those are a lot of questions there, but I know that you're well positioned to answer those. So I'd like to start with you.
Yeah, sure. So it's an undoubtedly a challenging time for those delivering health and social care in the UK. Sort of everybody gets that. I think everybody will have seen the headlines, not only in the UK, about sort of instances of COVID outbreaks in care homes. What I would say at the outset is we're pretty close to all of our operators, and I would say the picture is more balanced than the impression you might get from the press. There are lots of care homes who haven't had any cases of COVID at all. There are lots of people in care homes getting COVID and getting better, but clearly there are some big numbers for some care homes. And I think some of the issue and the uncertainty has been compounded around the slowness to roll out good testing and estimations that had to be made even on the ground about whether patients had COVID or not. And certainly we sort of see that, I think, in terms of the way some of the deaths are being recorded at the moment as well. So I would just say, so stressing that balance point is really, really important, that the situation is very, very variable between homes and between operators. Some of it is down to luck. Some of it is how they're dealing with it as well. And then really looking at the range of care facilities there, so elderly care. So from on one side, you've got very, very small homes sort of looking after, 3 or 5 people. On the other side, you've got a lot of, or a few sort of 100-person plus care homes as well. We invest only in modern purpose-built care facilities, so they're brand new, they're designed for that purpose. They tend to be around 60 to 70 beds per care home. They're all en suite, so everybody has their own bathroom. And as a result, you can sort of isolate those kind of buildings more easily, so rooms and certain sections of it as well. Clearly, staff have been sort of quite busy getting to grips with all of this. In some areas, they are quite fatigued. But what I would say is there is still a need for the really high quality of care that is delivered in these environments as well. And sadly, what we know is happening is there are some people now not in care homes and in care facilities who should be, and are being looked after in their homes when it is not the right place for them. I think in the short term, there probably will be a bit of an occupancy drop in care homes. But I think part of that is because people now and people who are either furloughed or not working are perhaps looking after parents, grandparents that they ordinarily wouldn't do when they're at work. So as soon as that changes, people are going to go back and not be able to deliver that care in the same way that they do. But we don't see long term any change to that underlying demand for good, high-quality, purpose-built care facilities where people are looked after by appropriate professionals. So in a lot of cases, nursing and increasingly dementia and Alzheimer's patients who need specific environments, need specific care to do that. And that is still in the UK underpinned by a shortage of supply of those kind of facilities. And too many facilities aren't fit for purpose at the moment still. And I think there's a growing understanding that I think some of the much older facilities that really aren't right, so still sort of converted houses and such like that, aren't working that well. And actually if you do have your staff, your 2 or 3 key staff needing to self-isolate or catching COVID, for them it's even worse than for a big home where you've got a range of staff you can rely on. There's not such a key person risk as you'd sort of call it in business. So I'd say, just to summarize, so the picture is much more varied than perhaps the press is putting across. There are some really great cases, operators dealing with it really well. And I would say, just a final new point is, operators are used to dealing with infectious diseases in the home environment. So we talk about the seasonal influenza outbreak in the UK. That is a really big thing for UK care homes and has been forever. They're used to dealing with infectious disease like this as well. So I don't think it is all, oh no, there's just absolute panic and pandemonium in every single care home in the UK. I think that is an inaccurate picture.
Okay, thank you. Christoph, and then Tom.
I'm not directly involved with our care homes, but just from the conversations I've had with colleagues, I mean, I think, the picture is more complex, as Ed says. Our care homes, luckily have been relatively sort of unaffected. They have had, cases of COVID, most of them. And I think that's, even though they have really been very, very strict on visitors. In fact, they basically locked themselves down to visitors. Nevertheless, staff has to come in, of course, and staff are oftentimes the first ones to bring it into the care home. So it is unavoidable. But, I think when we first came into this crisis, we were quite concerned. We thought this may sound very, very severe, but we were concerned also about actually a large part of the target population for these care homes actually, dying while the government wasn't shutting down. I mean, we were really, really concerned that actually this is going to be absolutely terrible for the population at large, for the elderly population, and of course, in consequence, for the ones in care homes. But that actually hasn't come to pass yet, of course, thankfully, because of the strategy then in the lockdown that the government implemented. I think specifically we've got a sort of number of care homes. The stock is certainly smaller than what Octopus have. Across our care homes, we haven't been too badly affected, so I can't really say or can't really see that there's a massive crisis happening at the moment. It is clearly concerning, and if I had a relative, a parent at a care home, I certainly would be concerned. But I think at the moment, as far as we can see, it is relatively well managed.
Okay, Tom, care, but also physical real estate-based medical facilities as well, if you're able to broaden that out.
Yeah, well, we've never invested in a care home and I know nothing about them. But as a venture capitalist, that doesn't stop me having a very strong opinion.
Right.
The only thing I would say is we've seen an interesting trend in the US, which is the US market of nursing homes, skilled nursing facilities used to be a really profitable place. And then it went through a period where it became really tough as insurance payments and coverage and pricing was getting squeezed. And what we've seen in the last kind of couple of years, and it's principally through a portfolio company of ours that has got a vital signs monitoring patch. So it's a little patch, you pop it on the patient's chest, and it takes pulse, respiratory rate, ECG. It tells you if the person's fallen over. So it's like having them wired up in a hospital, except the patient is free to walk around their room, go to the loo, have a walk in the garden, whatever it might be. And what that's let people do is to have basically much sicker patients exist within the nursing home environment. So they basically have dedicated beds or rooms. They have access to medical staff, maybe at local hospitals or other healthcare facilities. And what that's letting them do is, rather than selling a bed for $50 a night to an elderly care resident, they're getting step-down patients from hospital where the insurance companies were paying $1,000 a night. And they're picking up those patients and paying $500 a night and having them patched and having them with healthcare provided on an emergent basis if the patient starts to deteriorate. And, that's great because they're nicer environments than being in hospital. It's easier for other people to come and see them. It's great for the nursing homes because it's a good stream of revenue coming into them. And actually, some of those patients maybe actually do need to go into a longer term care going forward. And so it's a more gentle kind of move into that. So, I think, back to my slightly worn theme of today, which is trying to get stuff done in lower acuity, lower cost environments. I think if I was someone that was in the care sector, I'd be sitting there today saying, well, I want some of those higher risk, higher value hospital patients, get them into my care home. If you can turn a room you're making $60 a night out of into a $600 a night, that makes a massive difference to the economics of your business. And actually, with tele-health solutions, the cost of delivering that enhanced care isn't that much higher.
And just to add to that, and we are seeing that at the moment, so it's interesting. So often local authorities who are responsible for delivering social care in the UK have bought beds in care homes previously. What we've seen over the last couple of months is the NHS doing it. and that is for that step down care. So whether it is elderly people who were sort of colloquially known as bed blocking, or improving COVID patients coming out into a more appropriate environment for them, and then going back when they do get home in better health than they would otherwise do. I think in the UK, the big thing has always been recently just the level at which local authority beds are funded in care homes has not been sustainable. It is too low, and compared to the private pay fees, so we sort of look at care homes in that middle and upper market where people tend to be paying for their own residences there. It is the local authority funded care homes that have struggled, because with staffing costs and every other cost on top of that as well, it is very difficult for those to be run profitably.
We're coming to the end. There's one question from the audience that I'd like to ask you, and just to answer it quickly. From a healthcare perspective, given the human element, are equity providers more pressurized to, quote, dip their hand into their pockets and remedy situations as opposed to other businesses? A quick answer from each of you. Christoph, do you feel under more pressure?
I mean, the human element is absolutely important here, because it's not like you're dealing with some sort of gaming industry. You're dealing with health, which is the most precious good, in patient lives, and so that is always a consideration.
So that's a yes.
Yeah.
Okay. Ed, yes or no?
Definitely yes.
Tom, yes or no?
Sadly, yes.
Okay, thank you. Now, final question. I'd like you all to think of an investment you've made, your favorite investment, and why. Obviously, it'd be probably appropriate if it were in the health sector, but I'll allow other answers if you feel compelled. So, Ed, we'll start with you. Your favorite investment and why, quickly.
As I said before, I think any brand new health facility you've funded out of the ground. So you've taken it through the whole 3 or 4 years, through planning, through everything else like that, and got it up and standing. It's delivering care. It's pretty satisfying to see that end result.
Great. Christoph, your favorite?
Yeah, I mean, it's got to be Orchard Therapeutics, curing young kids who were destined to die and giving them a healthy, long life. It's got to be one of the most exciting things we've ever done. So.
Great. What's the name again? We didn't quite hear.
Orchard Therapeutics.
Orchard Therapeutics, thank you. And Tom, your favorite and why?
I think it was a company called Biovex. It developed a cancer vaccine for melanoma, which was about 5% of patients were surviving out to 5 years and had a complete response rate in about 35% of patients. I think it was a real breakthrough in terms of medical technology. Nobody thought cancer vaccines were going to work for 20 years, and it turns out they do. And taking a group of patients that had no hope and giving them hope, and we made a lot of money.
Right. Well, that's a good reason for it to be a favorite and a fun, nothing to be embarrassed about at all. In summing up, I just want to summarize what I think have been the main conclusions. I think all the panelists basically think that healthcare in the developed markets as a percentage of overall GDP will probably plateau, maybe a little drop in the short term, maybe then rise and then a plateau, although in the developing markets they will grow. The world should be like Germany and Sweden. I think lots of people would agree with that, certainly in the health area. Maybe football as well. I think a view that governments will sweep in certain circumstances to limit the profitability of companies in certainly politically charged instances, and that obviously will have some negative consequences down the road, which may be unintended, but we need to be mindful of. I think when we talked about the private sector and its role in health, there was a sense that the private sector does have quite a role to play in the stuff around the health sector. So maybe not core care, but maybe some of the accessories around care, some of the things around care where I think they can play a role, or where the panelists rather think they can play a role. I think there was definitely a view to beware of hype and buzzwords. They have an effect on valuation, and we need to look through those words like AI, telehealth, robotics, etc., and focus on what the real impact in a direct sense these things have. And from a portfolio management standpoint, I think the key that funds deliver that is really important for you as limited partner investors of the audience to keep in mind are those really expensive things that maybe an individual enterprise can't deliver. Things around finding great people, around some of the consulting work that Tom talked about, also dealing with some of the regulation, and also how to develop a management team. I think that was quite clear. So I think those were some of the things that came up. That's it for now. I just want to remind you that we have 2 more upcoming. Also Thursday at 2 p.m. on June the 4th, greenwashing. And on Thursday, 2 p.m., the 25th of June, debt funds. It last leaves me to thank our three panelists, Tom Castagli, Ed Clough, and Christoph Rudig. I think they did a great job of illuminating an important and vital sector of real interest now. And I want to thank you all for that. Thank you for your questions and wish all of you out there a good and safe afternoon. Thank you very much. Have a good day.